Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Jun-sok, professor of economics at the Catholic University of Korea. Professor Yang, good afternoon. Thanks for coming on today.
Happy to be here.
Well, inflation, as we just heard, came in the U.S. at 9.1% last month, the highest since 1981. Seems that'll make the Federal Reserve more likely to keep raising rates by 75 basis points at a time or even more. What do you make of the inflation data?
Okay, I must admit I was a bit surprised myself. I think most analysts did expect numbers to worsen a little bit from May's numbers, but not this going above 9% was very unexpected. As mentioned in the last story, the expectations by analysts centered around 8.8%, but the actual number was 9.1%, and the same thing goes for core inflation as well. The expectation was 5.9%, and the actual was 6.1%. But in these fast-moving times, what is perhaps more important is not these year-on-year figures, but month-to-month figures. And as pointed out in the last story, those monthly numbers came in higher than expected as well. And what's even concerning is that it seems to be accelerating. The 1 month inflation rate for May was 1.0%, but for June it was 1.3%, so it accelerated. And the core inflation, which excludes energy and food, which we expect was the main culprit for the inflation so far because of the Russian invasion into the Ukraine. They accelerated from 0.6% in April and May to 0.7% in June. So it has to be very alarming for the Fed to see inflation perhaps accelerating at this point, and not just the energy and food prices, but the core inflation, which is supposed to exclude those factors. Now, there is some slight hope that inflation may have peaked. It comes from two factors. The first is that some of the rise in inflation this month was due to higher inflation, higher prices in the service sector, and that partially is because service sector's prices fell so much during the pandemic when people were distancing and they were not consuming very much services at all. And now, as distancing is over, we have more travel, there's more tourism. So those services prices are returning to normality, and that seems to be reflected in the U.S. inflation figures. But if you want to consider global inflation, because services mostly affect U.S. domestically, whereas goods prices have their impact is more international in nature, that may be a sign that perhaps global inflation, though not particularly U.S. inflation, but global inflation may start to slow down. And then the second hopeful factor is that in the last 2 weeks of June, oil and some of the raw material commodity prices have started to fall. Because these prices started to fall at the end of the month, they may not have been captured by the government statisticians. And President Biden has emphasized this point, calling the consumer price index data out of date. But it's unclear whether the Fed can act on these hopeful but partial data when they meet at the end of July, and it may depend a lot on how oil prices go. Right now, it's at $96 per barrel. If you look at the last 2 weeks, it's definitely on a downward trend, but there's been a lot of ups and downs. Only a few days ago, it was $104. Last week, it was went up from $98 to $104 before falling down again. So we really need to keep an eye on those oil prices. If the oil prices keep on definitely falling, then the Fed may decide the CPI data was indeed out of date, and they may settle for a lower rise in interest rates. But at least currently, I wouldn't bet on it.
Okay, so we could see some changes in those numbers if that oil price decline continues, sounds like. But we have to talk about the effect of this on the equity markets. Wall Street started out with a big decline, but that was tapered by the end of the session. At the end, the Dow was the lowest of the three main indices, off by almost 0.7%. What's the story in the global markets?
Okay, well, yesterday was a day full of bad news for the U.S. markets. The Fed's Beige Book report shows that recession fears have gotten worse and businesses have become more pessimistic. And the report states that while the U.S. economy is growing, it's growing at a modest pace, implying that the growth is slowing. The general mood of businesses still seems to be pessimistic, but labor market remains tight, and consumer demand does seem to be still fairly strong. Businesses say that they are able to pass the cost to consumers, which seems to indicate that there may be more inflation in the future if more firms decide to pass the cost on to consumers. Now, the announcement of the CPI did raise the two-year Treasury bond yields by 9 basis points. 10-year Treasury bond rates rose only by 4 basis points, so the so-called interest rate inversion has actually worsened, and inversion is often seen as a sign of future recession, though nobody is quite sure how far in the future. But still, the market now seems to be expecting more and more that there will be a recession sometime in the future. European markets, they were all down yesterday due to U.S. inflation data. Asian markets today, they were mixed, with Hang Seng and Shanghai falling while Nikkei rising.
Well, the Bank of Korea took a big step of its own on Wednesday, raising rates for the first time by 50 basis points. Early in the session today, the KOSPI was down to almost the 2,300-point line, but recovered most of that. The KOSDAQ, on the other hand, closed higher. Bio and healthcare stocks doing well. Tell us about the domestic market.
Okay, well, the impact of U.S. inflation on Korean stocks were perhaps less than expected. As you mentioned, KOSPI lost in the end only 0.27% of its value. It ended today at 2,322.32. But somewhat surprisingly, foreigners actually bought about 399 billion won's worth of Korean stocks, even after BOK's big step in interest rate on Wednesday and the U.S. inflation data yesterday. So foreigners seems to be, at least today, optimistic on Korean stocks. Individuals and foreigners bought and institutions sold. And KOSDAQ actually rose for the day, which somewhat surprised me, but it was up 0.38% at the end of the day, and it ended today at 766.08. Individuals bought and institutions and foreigners sold. So the bad news seemed to be limited on the stock market, but perhaps not in the currency market. Korean won lost value by 0.61% today, and the won ended above 1,310 won at 1313.00 won per dollar.
Right, it seems to be settling in above 1,300, at least for the next little while. Professor, we're going to have to leave it there for today. Thank you, as always, for coming on. We appreciate your insights.
Thank you.